Everybody, good morning. All right, my magnificent monsters, grab your caffeine of choice. Me, I've got this, punk punch going on this morning because it feels like the entire global financial system is about to get punched right in the gut. Now, if you remember back August 5th, 2024, I unfortunately remember it very well because I got stopped out in the pre-market by the broker. Force closed. Pre-market. That sucked. Anyway, that was the day the yen carry trade blew up. The VIX, well, it went vertical. And every hedge fund manager in Greenwich simultaneously discovered some religion. It was kind of beautiful, but a terrifying mess. And it really aggravated me because by the end of the day, my trade would have been profitable. Yet I got force closed for a big fat loss in the pre-market. I was super frustrated. Anyway, South Korea just had its worst day since that yen carry trade thing blew up. The KOSPI, however you say that one, crashed so hard on Tuesday that it triggered multiple circuit breakers, halting trading while the grown-ups were trying to figure out what the beep was going on. And here's the thing that you need to understand. This isn't just about Korea. This is about a tidal wave of leverage that's out there in the markets right now. It's quietly been building up in the dark. And then suddenly and violently it unwinds everywhere all at once. And we saw this on the global liquidity indicator yesterday. I didn't really pinpoint it to Korea until last night after I was looking at the day. So within the next couple minutes, I'm going to explain a concept called the dispersion trade. It's a quiet, invisible force that blew up the Korean dream right there yesterday. And it's hiding right under the calm, placid surface of the S&P 500. Now, when this trade actually breaks, and the cracks are getting pretty deep right now, the illusion of stable markets is going to break down. And it's probably going to break down fast. Your portfolio, my portfolio, it's all on a fault line if you're long-term invested here. So today, I'm going to show you where the bodies are buried. I'm going to show you why a regional conflict in the Middle East could vaporize $270 billion from the stock market that's halfway across the world in a single afternoon. And most importantly, I'm going to give you specific three-phase playbook, the Unwind Cascade, to not only defend your capital, but go on an offense when the blood starts flowing in the streets pretty thick and heavy. So let's get into this whole thing. What do you say? How y'all doing this morning? Everybody doing good? Let's talk about it. So we've had Black Mondays, we've had Black Fridays. This was Black Tuesday in Seoul. To understand what might be coming in a bigger way, you first need to understand the sheer insanity of what actually just unfolded in South Korea. Just days ago, the KOSPI was the hottest index on the planet. It was smashing through 6,000 for the first time ever on February 25th. Hit an all-time high above 6,347 and was up about 50% for the year. Think about this. We just finished the second month and we're already up 50% for the year. Analysts at Norma were calling for 8,000. Let's baby rock and roll, right? Retail investors piling in cash. FOMO was thick. This could be Korea's 3X dream with leverage products. We were seeing crazy numbers. And I kind of warned that EWY, the South Korea ETF that, has exposure to all those different things, I was warning that hit the 1618 target. And it might pull back. And pull back it did. As this whole thing kind of unfolded right at the fib line. It's the craziest thing. We'll look at the chart here in a minute. Classic blow off top situation, though. The kind of euphoria that makes cynical old monsters like me start sharpening our knives and looking for opportunity. And then on Tuesday, March 3rd, yesterday, as it happens, reality hit like a freight train. The market opened after a long holiday weekend in Korea on news of Operation Epic Fury, joint U.S. and Israeli military strikes on Iran, if you haven't been following. And in response, Iran threatened to choke off the Strait of Hormuz, which I don't know how they would do it without a navy, but that's a different story. And that's the artery that carries 20% of the world's oil. For South Korea, a country that imports 70% of its crude right through that choke point, well, this was maybe a little more than an existential threat here. The result, KOSPI plummeted 7.24%, erasing $270 billion in value in one session. Foreign investors, the same fast money that fueled the rally, dumped a record $3.5 billion of stock and headed for the exit door. It's like the musical chairs. The game's over. Let's grab the cash and run. The crash, if you want to call it that, was so violent that the exchange triggered multiple sidecar circuit breakers to halt the program selling and prevent a total system meltdown collapse. The AI darlings, we're talking about Samsung Electronics, and usually a bellwether of the Korean economy because of the exposure to global markets, dropped almost 10%. SK Hynix, this is a critical supplier of high bandwidth memory now that MU decided to step out of the consumer market. I've been talking like Samsung and SK Hynix, they're the solution for memory at this point. And SK Hynix is a critical supplier of high bandwidth memory that actually goes on NVIDIA's GPU boards. It was down 11%. I mean, bit of a bloodbath compared to being up 50% for the year. And this was all triggered by a geopolitical flare-up 1,000 miles away. Maybe it's just the excuse. But why? Because it was the pin that pricked the leverage bubble. You could throw so many straws on the camel's back, but eventually the one is going to be the last one, and then everything comes down. And that brings us to the big scary idea of the day. And this is the part that they don't teach you anywhere else. For the past year, the smartest guys in the room have been making a fortune on something called the dispersion trade. Here's a simple analogy. Imagine you're betting on a basketball game. You can bet on the final score. I mean, say like final score 100 to 95. And that's like the index. That's like betting on the S&P. It's kind of boring. You can bet on how many points individual players score. And that would kind of be like betting on single stocks. The dispersion trade is kind of betting that the individual players' scores will be all over the place, even if the final score is close. You bet that player A will score 40, player B will score 5, player C will foul out with 0, and so on. And you sell a bet on the boring final score. Selling index volatility is the analogy here, which has been quite cheap. And you buy bets on wild individual performances buying single stock volatility, which has actually been quite expensive. This trade has actually been a home run because the market has been a tale of two cities, if you will. The AI winners like NVIDIA have been going to the moon, while the old economy stocks have been left for dead. The dispersion between the winners and the losers has been massive. Even while the S&P 500 itself has not really done much of anything for months and remained relatively calm. But there's a catch in all of this, and the dispersion trade only works when stocks are moving in different directions. It breaks down, and it can break down quite violently when we have a correlation spike where everything starts moving in the same direction. When macro shocks hit, like a war in the Middle East, and suddenly and subsequently oil starts shooting up and nobody cares about next quarter's earnings, they're going to sell everything. Everything's moving in the same direction. Down as we've had it the last few days. At least it seems like everything's kind of going down. And then today, a little bit of reprieve. The winners, the losers, the good, the bad, we're putting it all through the wood chipper together. When that happens, the people in the dispersion trade get vaporized. They were short index volatility. And when the VIX suddenly rips from a lower price, 10, 15, 20, up to like 40, they could get blown out. They were long single stock volatility, but it doesn't really matter because everything is going straight down in a line. And they're forced to unwind, which means selling single stocks and buying back their index shorts, which pushes the VIX even higher, which forces more people to sell. It's kind of like a death spiral cascade. And this, my friends, is what just happened in Korea. And it explains why we had that large put gamma down there so far below where we were trading on Monday. This is what they were betting on. And this is what's starting to happen under the surface in the US markets. So how do we play this all? And it's not really about panic. It's about process. I call the framework the Unwind Cascade. It has 3 distinct phases that are going to kind of play out. Right now, we're kind of in phase 1. And phase 1 is that flight to quality. When leverage breaks, capital doesn't ask questions. It's sell everything, figure it out later. It flees to the safest, most liquid assets it can. For most of us, that means US dollar, and that's why we've seen it spiking the last couple of days. The world's reserve currency is the ultimate safe haven. The dollar UUP could be a way to play. Then you have treasuries. As fear rises, money pours into government bonds, pushing prices and yields down. TLT, 20-year treasury ETF, is a way you could get exposure there. And then you have mega cap quality. And we actually saw big caps, Mag 7s, holding up really well the last couple of days, despite all the selling in other places. In a crisis, people don't want speculative growth. They want fortresses. I mean, we're thinking about like Apple, Microsoft, companies that have impenetrable balance sheets and a long history of making it work in all kinds of markets. And then we have direct hedges. And the trigger for crisis, in this case, is war and oil. And that means defense stocks, actual defense, like actual military defense stocks like Lockheed Martin. And then you got oil majors like ExxonMobil. And they become direct beneficiaries in something like this. Now, your job in phase 1 is to be defensive of your portfolio. Get out of high leverage, speculative growth, garbage, things that have negative earnings, and into the financial bomb shelters if you want to stay away from the carnage. Now, phase 2, the volatility spike. And this could play out in the next few weeks if things keep going, as everybody's alleging that the action in Iran probably will. This is the most dangerous but opportunistic phase of the whole thing. If the dispersion and unwind accelerates, the VIX will not just rise. It's probably going to explode higher. And this is where you can actually make asymmetric bets. But you must be careful. This is not about piling your life savings into UVXY. I mean, that's probably a ticket to the poorhouse. This is about buying small, defined risk positions. Think about like short-dated VIX or put spreads on the QQQ. They're lottery tickets. They're not investment plans, all right? You're rolling the dice here. You're betting on a panic. And the panic may not pan out. I mean, you're betting on not really a black swan, but a black swan. I mean, it's, you can kind of see the train wreck coming, but you got to position accordingly. The market can zig while you're zagging. Now, for most people playing this, for most of you watching, the best move here might be to simply watch from the sidelines. Hold your phase one assets. For those with you a little more risk tolerance, maybe you dip your toe in a little bit, but don't go all in, all right? Be smart. Now, phase three, the opportunity after the unwind actually happens here. After the storm comes the calm. After the panic selling, correlation is going to peak. The VIX will start to fall. The market will begin to differentiate between good companies and bad ones once again. Come back to sanity. And if you had gone on the defense in phase one, this is where you can go into offense and actually pick up some opportunities. The contrarian rebound here, this is where you can look at assets that got unfairly beaten down. The Korean ETF, EWY, might be a good example if the geopolitical situation actually stabilizes here. Something to watch. You could restart the wheel here. The best part of volatility spike is that it juices options premiums. Selling puts on high quality companies, high quality compounders that you want to own anyway. The Apples, Microsoft, the Googles, the other things of quality that might be beaten down. You can get some fat premiums while you wait for price to dip down to your level to buy. I mean, it's kind of the monster way. So here's the deal though. Korea's crash isn't a problem. It's kind of a symptom of the bigger disease of leverage, and the catalyst is a world that's becoming dangerously unstable. The dispersion trade unwind, it's a mechanism that transmits that instability from a region of conflict into your 401k if you plan it properly. But don't be the retail investor in Korea who bought the dip on Monday and got their face ripped off on a Tuesday. Be the monster who sees the cascade coming. Your homework is simple. Review your portfolio. Are you in speculative junk, or do you have some quality stuff? Your first move is defense. I mean, flight to quality. Make sure you have some quality. Your second move is patience. Watch the volatility spike. Unless you got a high appetite for risk, just stay on the sideline here. And third, when it seems like everything's starting to settle out here, when the fear peaks, that's the time to be greedy and pick up some opportunities. SVXY, that's a great time to pick it up, is when VIX hits its 40 peak, if we get there. Playing short volatility for the unwind. And that's how you survive. That's how you profit from the panic. Now, go finish your monster, finish your caffeine. Let's jump into some charts. Check it out. Hopefully that was helpful. You can let me know. Dun, 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 dun. Before we talk charts, though, all trading involves a substantial risk of loss, and past performance is not necessarily indicative of future results. This presentation is intended to be informational, educational, fun, entertaining. It's not a recommendation to be buying stocks, options, bonds, forex, futures, cryptos, treasuries. If you trade those things, you're probably going to lose money. That's what 90% of people do. And if you want somebody to tell you what to do, how to be smart with your money, you can hire and consult somebody. I suggest you just learn it yourself, but be careful out there. Be careful out there. If you do it naively, you can lose your money. You can lose your money. And look at it yesterday. Quite interesting here. We had this red box defined based on the gamma. Looked like we might take a bath, but we ended up rallying back up to the roadmap line. It really shows the power of this baby right here, I feel like. So even though we had gamma, it looked like we were going to go visit this level, and it's still sitting out there. This unwind thing may not finish unwinding for a couple weeks. Just be careful. We'll predict these here in a little bit, where we expect it to go today, what the range is. So yesterday, a little bit aggressive on the bounce. And then QQQ yesterday, again, a little bit aggressive on the bounce. And funny enough, we hung out right there until about 1. And then we popped on up here. And today we're back to the roadmap line on the 15-minute. We'll take a look at this here toward the end of the show. We'll bring up the gamma charts, which if you've not seen it, we'll bring these over, kind of check this out, try to figure out where prices might be heading. Yeah, looks like we wiped off that 1.5 billion level that was in there yesterday. Now we're sitting here with a $480 million level sitting out here for the 13th, which is next Friday. The main monthly expiration is out here on the 20th. And we're kind of up here. A little bit of a bubble starting to form. Looks like we'll have to circle back and check in on this after we give it a little bit of time. Amateur hour, first kind of hour of trading. Things are all over the place. So give it a little bit, let a lot of options fly. Maybe we can, this is the best looking bubble we've had on QQQ in several days. Like yesterday was just a smattering all over the place, at least early. But interesting is this bigger level down here on the monthly hanging out at 590. But that's still a couple weeks away. And we look at still, this Friday, next Friday, the 20th is down here. It's interesting we got a big level building up out there. Now it's not in the $1 billion, so always got to take that in stride. So the potential for more downside chaos is still sitting here. Look at the chart here from early February all the way through. We kind of keep hitting a floor. This was a lower low. So the only real requirement for this correction to have been done, if this was the move up, 1, 2, 3, but that went lower than that one. So, we'll have to look at this bigger. This could have been 1, 2, 3, 4. That could have been the 5. That could have been the A. That could have been the B. That could have been the C. And game on for going higher. We met the requirement for that to be complete. Kind of. It would be a truncated C unless we extend down lower than the A. We did a 5-wave down. Didn't get overlap. Made the lower low. But we truncated. Truncation is not usually the thing, so there's still risk to the downside, and we're still seeing that 590 played out there. It could dip on down in the 560 area if we got an extension. Jumping up, let's look at some more index plays here. S&P yesterday, look at that beautifulness. Look at that, A, B, C. So this one's a bit different because we had the high right back here. This was the all-time high, and that happened in January. This kind of a 3-wave correction, although this C is made up of 3 waves. So that's not typical. That makes it a big question mark here. Big question mark. Like, that's not typical. C's are usually impulsive. This big nasty right here was a 3-wave thing. That makes me cautious right here. What's about to happen? And now we've, potentially overlapped that first bit, so causes some, this is sloppy price action and causes me to wonder if this is going to develop into more sloppy price action in a more complicated correction than just an absolutely beautiful correction. ABC. This is starting to look like 1, 2, 3, 4, 5. It's starting to look kind of like a leading diagonal down. We could see a large pop back up in this area. and then start the next move down. Usually when leading, if this is going to be a leading diagonal, and this is a, this coming off the high, trend is down, lower highs, lowest low. If this is actually a diagonal, we get a nice big deep retrace. Continuation would be down on the S&P. It's something to watch out for. Something to watch out for. Now, jumping over and looking at the cash index, we tagged the roadmap line on the daily yesterday, and we hit kind of ideal proportions, but we still have that nasty 3-wave last move, which last moves don't usually end up in 3 waves. So this is some kind of weird corrective flat so far. We may get an extension. In Q, we've been sitting on this roadmap line for whole month of February. Couldn't make a lower low so far. And the bigger problem with NASDAQ is we made the all-time high back here. Back in October of last year. Back in October. That's where the all-time high hit. All the way back here. That was the first move down. This was kind of a sloppy corrective move up. So was this all of the correction? This possibly some sort of leading diagonal, and this is the deep retrace. And now we go higher from here? Or was this the first move down? This was the retrace, and we still have a lower low to go. That's kind of the two potential paths cooking on NASDAQ. And it doesn't really jive with S&P 500 so much. So we have divergence between the two big indexes. They're not on the same path. This held up incredibly well yesterday. Did make a lower low. This A, B, C could be complete, even though that C was kind of sloppy. Again, sloppy price action here, but this could be all we needed right there to go higher. This one's been on a different path. This one made its highest high right there in January. It didn't even have like any kind of attempt to make a higher, the highest high here in October. We've just been ripping higher on these small caps. And this kind of back testing that, grab my drawing tool, this kind of back testing that area right there where we hit and broke out of, back testing it one more time, sets us up for a potential rally to 3,100 on this one and an outperformance compared to the two big indexes. Now, how would you play this? IWM. That'd be one way. UWM. Another potential way. I'm not saying they're not without chop, but if you wanted to just buy shares and sit on them for a little bit for a potential pop, maybe up in the 70 area, UWM would be a way to play. If you wanted to play some options, IWM would probably be the safer play than UWM. Oil. I know there's lots of opinions about how oil is going to work and all this stuff, but this right here is a caution flag on the play. Big picture, years-long pattern, still suggesting we're going to see 40 to 50 before we make the bigger rip to 100. We are currently retesting those highs from the last time missiles were flying, last year, when missiles were flying in Iran. Kind of testing that same spot. I mentioned this was going to probably happen when we touch down in the mid-50s. There's probably going to be some kind of conflict that pushes oil back up here because they need that. all their Middle East economies run on more expensive oil. But then this is looking likely to push back down, make that lower low. Still a giant downtrend. Still the ideal price to bottom out right down here in this zone. And this has been a big correction since we did the big spike back here in 2022. Made this big spike, and we made the first move down, A, the retrace back into the resistance zone, B, and this has been kind of a slow, sloppy slog, and would look best with the best proportions and the best everything if we touched right down here, maybe as low as 45. This is just a little intermediate spike before we potentially take that last little dip. Be pretty detrimental if oil basically got cut in half. Be counter to what a lot of people are kind of expecting right now. Now, flip side of this, if this was done, if this whole move bottomed out right here in December, you know, I did warn that when we got through the roadmap line, we were going to come test this downtrend of highs that we've had intact since 23. And if we got above that, we could be on a path up here to retest 100, that 618 level of that whole big drop from the high up here to the low down here. That's the lowest low right there. 618 retest. So we could spike 100 and then come on back down. And this be a whole A of a bigger correction, B of a bigger correction, and this could actually push it down in the 20s maybe for the C. That's an alternate path, both kind of bearish. I'm not sure that this is done here on the downside, and I'm not sure we're going to break higher, but watching what happens up here, if we do spike that, that's going to be the key. Gold probably going to take its next leg lower. Now, I know lots of people aren't betting on a drop in gold, but that move down, copied right here, highly likely to happen. This move up was proportional, had a very nice ABC. No weirdness here. This was all just really clean price action. And right now, this supports a drop back down in here to the roadmap line, if not below 4,000. Be careful. Warning signs are flashing. Silver has the same sort of thing. Very beautiful, proportional correction right up to that 618. This is a measured bounce. This support's dropping right down in this area below 50 on silver for a nice big fat correction. First move down, second move down, right down in there. Bitcoin on the path, probably coming right up here. Has nothing to do with anything. This is just price action right here. I mentioned that would probably be a fake breakdown, and then we go right back up here, and that's where we're going. And then we'll probably do the B wave correction. Then we'll do the C wave up into, and that'll kind of be this whole path right here. First move down, A, B, C correction. This is the A, this is the B, and then we do the C down into that 30 to 50K zone out to October. Don't get caught on the wrong side of this thing. So far, it's doing exactly what I thought we were going to do. And we're going to come up here. We're going to do this. We're going to do this. Find resistance in this area up here. And then probably take another spill, lower low than this over here, and wrap up this correction. Probably, plus or minus a month, but October. Ethereum, same kind of joke, same kind of junk, same kind of joke. Probably going to rally back up, maybe to the roadmap line, correction, move on up, and then lower low out here later in October. Dollar, taking a little rusty. So this hit the proportions for 3 waves. So it's time for caution here. This move right here, 1, 2, 3, 3 waves down. 1, 2, 3, and that was a lower low. 1, 2, 3, 3 waves up, and that's a lower high. We did break through the downtrend of highs. We did break through the roadmap line, but this A, B, C 3-wave proportion was perfect for this to get continuation lower. And this was not the most impulsive. I mean, we had a low at 1, 2, 3, 4, 5. Blow off 5. Everything might be chilling out here. We could see this return back down. Go lower low. The tell here on a breakthrough 102, we're probably going to start stopping out the dollar. The short dollar trade. Short dollar's been a thing for a while. Really ramped up last year, pushing it down. We started this whole correction though back in 22 again. This thing may need one more push down. Finish it up down here around 92 to 94, and then we embark on the bigger rally. Just be careful. Watch out. You know, if this actually finishes a 5 up, I got to take it day by day because you got to see move by move. Right now, we found resistance at the 1272. That's indecisive between bullish or bearish. If we kind of pause here and then go ripping right up here, get up to 100.5 or higher, then this is saying this bottom is the bottom. It's kind of like confirming that bottom's the bottom. Probably come up here, maybe get a bigger retrace to the roadmap line, and then probably embark on that 130 to 140 target on the dollar. NKD, a little bit of reprieve on that first drop. Came back to back test. So this is time to watch. We'll probably get a little move up. If we find resistance at the 618 retrace, start arcing back down, this is going to accelerate. That acceleration could get pretty violent. Let's remove a few things. We're up to kind of the target level here. Now, ideally, we could come up just a little bit higher. Now, that pullback right there, that pullback right there, kind of proportional to each other. Kind of an echo. We could see another pop right up here. So you got to watch that 618 retrace here. That's the tell. Is global liquidity going to keep on winding? That kind of tells us right there at 57,000 on the Nike. If we turn down, probably coming down for a deeper unwind. Now look at it. Look at Mag 7 stuff. Chat's awful quiet today. And Apple hung out pretty well. Like, we seem to be relatively unaffected. We have this uptrend of lows that's been cooking for a couple months now. Downtrend of highs. It's kind of squeezing in here. If we can pop out of that, 295 is the target. If we break down out of this, probably come down here to 205 to 210 area, maybe 220 area. Somewhere down in this box would be the downside. I don't think the roadmap line, as flat as it is going to provide much support here. Amazon, as briefed, that was probably the low, probably going higher. My initial target is back to the high, right up here around 250. Google. Looking for that to finish up the correction right down to the roadmap line here. Meta. Scaring everybody. It's crazy how I predict all this stuff before, just off of price charts. I don't doesn't even have to do anything with geopolitical anything. It's funny how the geopolitical stuff falls into the chart patterns. Lower highs, higher lows. But this was the ideal retrace here on Meta. As briefed, higher low, higher low. If we can break out through this prior high, fill that gap, game on. Probably 1100 to 1300 is the target. That could take a couple years. If you're new here, welcome to Big Bold Prediction. Meta coming on up here. Microsoft. It's kind of in a danger zone here. We went below the ideal support. Like Meta stopped right there and bounced, made a higher low, but Microsoft continued to push below it, creating a question mark. Is this going to hold? We need to rally back up to the roadmap line, probably get a retrace, bust through it, back test it from the top, and get some upside going if we're going to go higher. Otherwise, this could develop into a lower low situation down at 320. NVIDIA. And so far, the earnings thing played out exactly like I thought. We hit that upside target, and we retraced right back down to the roadmap line. Now, the thing to watch, we got to move this all forward. Here's the high, here's the low. The resistance level is right here. That 188. If we bounce off of that, further downside, support down here around 150. Why 150? Because that's the breakout of the highs from not this past December, but a year ago. December. Right there. We made those highs. We did that Liberation Day retrace. We came up. We didn't even stop. We didn't even pause. We just broke on through and ran out of steam. Now, we're going to have this long retrace. Probably going to retest that breakout before we can go higher. And if we get through it, if we bust through it, we could come on deeper back to the 618 retrace around 120, like we saw on Microsoft and Meta. Tesla, with that push lower yesterday, with that push lower, either that was a deep retrace, the deepest retrace. We're down to the only a few dollars left. If we make a lower low than this low right here, highly likely we're going to step on down to 370. But as long as we hold on to that, as long as that was the low, and it is above that low from back here around Thanksgiving, we can go ripping higher here. But this is definitely pushing the limits of the price action on Tesla. 370 is more, by doing that yesterday, 370 is a distinct possibility. It's definitely in the cards. It's kind of 50-50. Do we bounce down here, or do we break out above this and go higher? So your tail back above like 415, 420, back above that zone there. Probably going higher. Higher, 550, 600. If we reject off of, this roadmap line or this area right up here, 370s in the cards. And right now, I'm not highly confident either way. I'm just sitting on my TSLL selling puts and calls. Netflix trying to push through the roadmap line. Really getting in there and testing it today. If we reject off this, that 60 to 70 zone is still the target on the downside. And the upside right now, resistance at this 618, right here around 108, 109, 110. Resistance right in there, but the big zone We're at the bottom of the big zone right there. The big zone comes all the way up to 120. We have the gap down, kind of sitting here that we're starting to push into. There should be some resistance in here. But if we can pop on through, we might go actually on to higher highs. This whole big correction, way extended, retested these lows from Liberation Day, poked below it actually. Now we're set to potentially go higher, 145, 150. But we got to get through that resistance up there around 107, 108, 110. And we do have another gap down right here. So gap downs provide resistance because there were people buying right up into that high. Then it gapped down and surprised them. And then they probably doubled down, tripled down maybe. And they just want their money back. So when they get back to scratch, they sell, and that creates down pressure. And we see this over and over and over on gap fills. Netflix shows this behavior over and over and over on gap fills. We filled that gap, sold back off. Filled this gap, sold back off. It's a psychological problem. Now, gap ups don't work the same way. People don't sell out of their stock here and then get caught and they're like, I just want to buy it back. That's not the way it works. You sell it and move on. But on gap downs, you're trapped and you just want your money back. So when you get your money back, you sell it. That creates that down pressure and resistance, filling gaps to the upside. Hopefully that helps. It's just a market psychology thing. And I go pull gainers, things moving up $2 or more in the pre-market. There were quite a few of them. Some of them turning around already. Be careful on the high flyers that have had no pullbacks. Lots of leverage stuff showing up in here. I don't usually find the best opportunities in the poppers list. Coin probably still has a date for lower, but probably going to come up here and test the roadmap line before we do. That 1, 2, 3, 4, 5. And that would be the first potential move down. Get a three-wave retrace for a B. And we could go down for a C. MSTR probably coming up to the roadmap line. Caterpillar probably due for a retrace after that massive. I mean, look at that. This thing does not move like this with nary a pullback. Like, that's just not. Look at the history of Cat. Like, we get them occasionally, and that one maybe played out right there. Look at that. This is not the standard for Cat, though. When we do one of those, which it's exactly the same size as the last one. Look what we did. A prolonged period of nothing. So Caterpillar could go into a prolonged period of nothing. GLD needs the pullback, as I mentioned on the GC chart. AMAT probably played out to the upside. We need the retrace. SMH needs to hit the roadmap line. A lot of these need to hit the roadmap line. Saw Mag 7s get rotated out, but a lot of these things didn't follow suit in the AI play. TER needs a retrace. PPLT. I was hoping for that to hit the roadmap line. It may do that on the next leg down in gold and silver. If we do that, we set up the next upside here. PALL is my potential outperformer. This move down. I want to see this come on down in here. Find a low. And because we got that close above that 618 right there, we set up this bigger upside potential, 364, 400. So I need a little bit more retrace here, and then we can see a massive upside. Massive, massive. And Corningware. It's funny, I talked about that being a potential AI pop, and then there it went right up in there. Watch out for retrace, though. core weave. You know, oh, couldn't stick the breakout. Pop through, poke through the roadmap line, retrace back down to the lows. We can hold on to this and actually break through the downtrend highs. This one can kick off a massive upside potential here. Circle, I like it. Optimistic we can break through the roadmap line. Just have a little bitty piece of one, not a long history of one. Optimistic we can break through, back test, and go higher. This looks like the lowest low. You would ignore all this price action over here. Doesn't mean anything. You would start with this right here. Now, what it can do is provide some resistance levels, though, because there were people buying into that high, and then they're stuck. So they may sell back out when we get to that. Find support at the roadmap line, break on through, and go back to the highs. That's one to keep an eye on. NBIS, just kind of chopping. Bloom Energy. Watch for the retrace. We hit the targets on the last bounce. We had the high, we had the low, and we hit the target. That was the entry. There's the target. Watch for the retrace. Could pop the next higher fib line at 225. Q needs a bigger retrace back down in the mid-90s. TAT. And needs a retrace. It's already played out the upside. Inium needs a bigger retrace. Robinhood probably bottomed out. Probably going higher. 170 conservative target. 300 bigger, more aggressive target. AMD, that was probably it. That satisfied what I was looking for. Right there. Lower low. One. Now this was an A, B, C, and it had the 1, 2, 3, 4, 5. Lower low. Beautiful. This is it. If you want to buy AMUU, I'm probably going to issue that today. AMUU. $40. I'm looking for a return to the high at the minimum, and actually 279. So the upside here, looking for from here to here. That'd be a 42% upside. So AMUU, AMUU. Get all the letters. Be looking for an 80% upside. So not back to the highs, but move from 41 to 75. Why 80%? Because this is 2x leverage. AMD up to the target supports a 40% upside, plus or minus a little bit. So 2x leverage, multiplying that by 2, right up there. %80 for AMUU. And that's where we get this right here. Target right around 74, 75. If you were to buy shares. And this is why when I talk about my patterns don't always work on leverage, when I give the warning, you got to be careful, because even though that 40% upside makes that a higher high, it doesn't make a higher high down here on AMUU. Looking on down. Oh, that's beautiful right there. Look at that double bounce. Hit there, came up, triggered the entry, hit here, holding. Gives you a very nice risk reward entry if you wanted to go after this. Stop is $1 below the low right here. Target 174, 173, 174 right there. Beautiful dreamer, come back to me. 180, 190 possible. HUD8 didn't touch the roadmap line, but potential for this to come on up to 127 on the bigger picture bounce. CCJ was on the poppers list, but now just kind of resting. Looks like it needs to retrace. Hadn't really touched the roadmap line since back here in May. KKR. Still got a little bit further to go on the downside to be proportionally. That looks like a 1, 2, 3. Could have a prolonged 4 and then a 5 that pokes down in that 70 area. CRDO. ONDL. It just looks nasty price action right there. That 2x leverage for ONDS. And it looks like it needs to hit the roadmap line. Dell. Now this set up a pop right here. That high, this low. That's the entry. That's the target. Possibly 187, possibly 217. Another biggest loser. We mentioned we would talk about this. EWY. Hit the target. Right? Here was the pullback. There was the entry. Went ripping right on through the 1.1448, right on through the 1272, and stopped dead cold right at the 1618. Funny enough that this would spark a big correction and highly likely to come back to test the breakout. Another 30 points down. I was warning on the 3x leverage KORU that this pullback back to the roadmap line was 34%, 35%. So when you take it over here with a 3x leverage, 35% down on EWY. %, is greater than 100%, which means this can go all the way to 0. Caution. That can come all the way back down to the bottom just on EWY retracing back to the roadmap line. That's what leverage does for you. That's why leverage is dangerous. Be careful out there. So this has no reason to have to find support here. It can just keep on trucking if EWY comes on back down to just the roadmap line, just to retest the breakout. Probably do a reverse split like this to keep it listed instead of going to 0. But if we take another swift step back on EWY, this is where the lead story that I was talking about. If we take another swift move down to here, we're here. We take a swift step down, 23%. Think about it, 23. It does it based on a daily chart, so it would have to jump down in a day to really destroy KORU. But that would be 69% on KORU. So 69% from here. If we did that in one day, you're looking at a move down to 100, which takes the whole move back from where we broke out from back here. Takes the whole move back. Be careful trading leverage. BATL, I wouldn't touch it. ANF, probably coming down to test this 85, and if we do and hold it and turn back higher, that gives a bigger upside opportunity on ANF. Short Bitcoin, getting punched in the face. That was played out here. Watch for the drop. Bitcoin could rally a bit more. Chevron pulling back, COP pulling back, XLP pulling back. And these all look a little played out. So setups, things we're set up for action today. Here's the high, here's the low, uptrend, pullback, activate the entry, 428 target. Be careful on low price stuff, things under 20 bucks, and especially down in this low price. Stop is always $1 below the low. So you think about that, $3 low, $1 below the low, that's like a 33% on top of this right here. And you're only looking for a profit right there, that little bitty. So this is, it really skews up the profit risk, the risk reward ratio. So be careful there. NNI, yeah, this one had a prior bounce, playing out. Here's the high, here's the low, there's the entry, 146 targets, stop was $1 below the low. Statistics 19, 76, 73.6, 1.7. So this under 30 trades in the history doesn't, there's no statistical significance for this one yet. We need 30, we need more than 30 trades for this to be in play. So these numbers don't really mean anything. The historical average across all tickers, 75% and 1.2. So 75% chance we'll have this pop right up to that 146 target. SEM. Wow, that's an interesting one. Here's the high, here's the low. Entry 16, lower price stuff. Be careful. Stop and be down around 1350. No statistical significance, but it does look promising. And Warby Parker, get your eyewear. There's the entry and 3281 targets, and stop is down here around 1990. Relatively new stock with no real history. Circling back around to figure out the day. What do we expect to happen based on gamma? Let's check it out. Check it out now, Funk Soul Brother. Where did I leave the Gamma Church? Let's see what we got cooking. Hey, good looking. Ooh, very nice bubble. This is a very solid bubble formed in here right now. So, top 691, bottom 682. Relatively easy today. 691, 682. Just higher than the open. And let's see where we might end up. Ooh, there's a big level forming at 690 up there. So big picture, probably go visit 690. On the upside, let's look at the levels and see where we might cause max pain. My max pain theory is a little different than the typical. I'm thinking 684 would be kind of max pain. So put this right down here. If we were going to pin and cause max pain, option holders, that would be where we hang out. We may come up to this big gamma level up here at 690 for SPY. Save that. Hide that. Hide that. QQQ. Then we'll go look at the. I'll go look at the futures charts and see where the tea leaves are telling me they might move to. So QQQ heat map. And wow, look at that. That's a pretty solid bubble forming. Looks like 616 on the upside and 604 on the downside. Yeah, so 604. Just move this whole thing up. 616 and 604 on the downside. Let's move these. here. Let's see where the big level is sitting. The big level's down here. So we may, I don't know. For today, 610 maybe the big level. And this is subject to change as players play. Players got to play. So we got 610 in here. And then look at the levels. It would make sense to hang out around 605. That's just me sitting there doing math averaging in my head, but I don't know if that's going to play out though. Calls could have the advantage here. So there's significantly less calls being played. Put skew is definitely very high, and the big level is out here. So, and we do have some calls being played today. We'll see what happens. That's the playing field so far, and we're getting a bounce. So be careful trying to cap off how far we might bounce. If we break above this 616, things could get a little crazy. Looking back at the futures, we've got resistance coming up. Now we're at the 1 hour resistance, and then the 4 hour resistance is right up here on S&P. It's up there at that 68.94. If we get above that, there's not really anything capping us in here except this downtrend of highs. Downtrend of highs, that's about the only thing capping us in here after we break through the 4 hour roadmap line. In Q, a little bit different situation. We have that bigger 618 hanging out up here at 25.5. If we can get above that, we might be, I mean, it's possible we're done down here. We could go on cruising to 27,000. So we got cooking. Downside still in the cards. Next leg, be careful. I'll be cautious, but it looks like we're gonna get a little bit of reprieve day here, a little bit of climb out of the chop. Hit those daily roadmap lines yesterday, so get a little reprieve. And maybe, you know, the gusto may be running out based on the options too, so be careful. Trying to bet directional. We may just chop around and then get some more flush out later in this week or maybe even next week. We do have the seasonality of March in play. If you've never seen this before, this big spike is a 20-year average of volatility. Typically see a big spike mid-March, so be careful out there. Seeing VIX take a little step back today, back in the 20 area, and this could be an opportunity to grab it before we get another big spike. Could be. Also possible that this is played out for now and we just drop back down. Yeah, we did spike to the vicinity where we've spiked for the last several months. Could be an all clear for now, but this also could have been the wind up for the bigger pop. Hard to say. Hard to say. If the unwind thing gets a little bigger, we could come on up to this kind of level. So loading back up at like 18 would be strategically smart, or even waiting down till we're down at 13. But remember, mid-March is coming up, so not far away there. And let me see. It's bar chart. Done ahead. Yeah, here we go. Keep in mind that the VIX option expiration happens on the 18th, not on the 20th. Right here. The last day to trade VIX is the 17th. That's why you get a bunch of chaos and then it chills out immediately, because we always have that VIX OPEX right there in the middle of the month. So be careful. The last day to play is the 17th. If you buy VIX monthly, last day to play is 17th. Last day to book your profits, the 17th. 18th is expiration. And then we reset for April. So careful out there. Be careful out there, my monsters. Have a great day. We'll see you later. I'll be on Market Masters 11:30. And be back tomorrow. Same bat time, same bat channel. 9:15 tomorrow.